not buying into this sort of notion that growth will slow further. We should get a bit of a recovery in growth, though it's a case that the pace still remains a bit on the soft side. And that weakness in growth over the first half of this year did contribute to a stalling in the unemployment rate. However, we've seen a bit of a downward move. Wasn't all that marked, but it was sort of a bit of a downward slope. It seemed to have been interrupted over the first half of this year. And that's sort of where the vulnerability of the U.S. economy is. This is still a fairly high unemployment rate. So it means confidence is still under pressure. You know, something negative plays out in terms of the political economic environment, it's sort of the wrong time for that to happen, because it could start then setting up a bit of a negative feedback loop with further weakness ensuing. So you want to avoid that kind of negative shock, given sort of where the economy is at the moment. Now, what people are concerned of right now in terms of what could deliver that negative shock is largely with respect to fiscal imbalances globally, both in the U.S. and in Europe. Now, in this graph here, it's a debt to GDP measure. You know, it's showing Greece with very high debt levels. Italy's up there as well, well above OECD averages. This at the moment is sort of where a lot of the concerns reside. You know, the ability of an economy like Greece to continue to service its outstanding debt, concern about a default occurring within an economy such as Greece. Our expectation on that front is that we will see aggressive enough policy that will allow various economies in Europe, Greece in particular, to manage the debt. There may be some element in terms of an attempt to reduce that debt load so that it is easier to carry. There may also need to be support in terms of the European financial system, European banks that have a fairly heavy exposure to Greek debt. There may also be an increase in the size of so-called bailout funds in Europe to assure that if any other economy starts coming under attack, the funds will be there to try to counter the attack, to prevent these financial market pressures from continuing. But it's going to need to be the case that Europe unifies on this and comes to an agreement in a fairly aggressive package to address these pressures. Our concern is, if that doesn't happen, the pressures that we're seeing in financial markets could intensify and could pose a risk in terms of the recovery continuing. Now, the U.S. is also an area of concern in terms of debt levels. As you see from the graph, you know, the debt to income is not anywhere near close to what we're seeing in some of the European economies, and it's running fairly close to the OECD average. The concern with respect to the U.S. is more after that debt ceiling sort of a debate that went on in the U.S. Is there an element of dysfunction in the U.S. political process? Have we moved to the point where there's not the preparedness of the two sides to compromise at all, to come to an agreement for the good of the economy, to make sure in the current environment that growth is sustained? Now, again, our assumption on that front is that we will get enough compromise that there will be sufficient support for the economy, as well as agreement in terms of preventing these fiscal measures from deteriorating over the medium term. Now, I think in terms of the current environment, the European situation is a bit more pressing, and it needs to be addressed more immediately. But you will also have to see indications in the U.S. of a bit more of a willingness to compromise. And I agree, this is not a low hurdle to clear. There are obviously challenges, but one hopes that sort of the politicians realize for the health of the, in this case, U.S. economy, that they act and act appropriately to contain these pressures. So our forecast is based that policy responds in an appropriate way. The risk is it doesn't, and that, in our view, is the main risk in terms of our forecast being realized of continued growth, that we continue to see impasse on the political front, which will likely result in pressures continuing in financial markets. Now, in terms of pressures that we've been seeing, equity markets have dropped fairly significantly. They've laid down. Maybe it's in part related to a lower growth profile, but it is also concern about sort of policy and action in Europe and in the U.S. And so you're seeing a drop in equities. The fall off in equities is an inflationary shock to the system. It represents a higher cost of capital. Firms are less able to raise money when they issue stocks. It's a negative for the economy. So it's a bit worrying when you see these precipitous drops. Now, if you put it in a larger context, so that's, if you look at the graph on the left there, it's going back to this over 10 years, but it captures sort of the pressures that we're seeing in financial markets with the subprime mortgage debacle. First kicked in 07, but continued very much through 09. So the drop we're seeing in equities, it is significant, but it is still not in terms of the kind of orders of magnitude that we were seeing in the previous crises. So at this point, if we can see the pressures being stopped out, I don't think it poses as great of a threat in terms of pushing the U.S. economy into recession. You get another leg down in equities, I start getting a little bit more worried. You start getting significant enough drops, it could jeopardize the recovery. The graph on the left is kind of a lending spread. This is another channel which sort of a higher cost of capital derailed the U.S. economy in the subprime mortgage debacle. Essentially, it's a spread that's looking at a wholesale cost of funds, LIBOR rate in the jargon, and it's held against sort of a more neutral interest rate, usually some sort of government interest rate. In this case, it's official rates, so for the U.S., it's a Fed funds rate, and it's actually an expected future value of Fed funds. But the main thing is, when the wholesale cost of funds go up, this spread widens. It's becoming more expensive, primarily for banks, to raise money in the so-called interbank market. But it's saying cost of funds are moving higher. Now, if you can look at the blown up sort of recent movements, the yellow line represents what's happening in Europe. Pressures are starting to emerge there, related to sort of sovereign debt in Greece. Are the banks that are holding that sovereign debt, are they sort of a safe bet to provide funds to because of that exposure? Financial markets are getting worried, so they're demanding a higher return to offer funds. So you're getting the spreads widening in Europe. We're getting close to sort of some of the initial pressures that we saw during subprime. Not quite there yet, but it's getting a little bit on the worrying side. And you are seeing central banks in Europe trying to address it, and trying to inject liquidity into this market to prevent the spread from widening further. Going forward, we're watching these sorts of measures, an indication whether the pressures are easing or not. If they start to intensify, we start getting a little bit more worried that the pressures in the financial markets are continuing. They start presenting an increasing risk of derailing the recovery. Now, encouragingly, we are not seeing pressure in the U.S., and that's very important in terms of sustaining the recovery in the U.S. Again, it's more worrying if we start seeing those pressures extend into sort of the U.S. Financial market. Now, that big spike in that measure, that represented the bankruptcy of the Lehman Brothers. Some people are saying, are what we going through sort of a replay of what happened with Lehman Brothers? As you can see from this graph, the pressure is nowhere near quite what we saw there yet. Though people, again, are watching these measures very closely, and worries will increase if we start seeing deterioration similar to what we saw prior to the last economic downturn. Our view is that policy actions will remain aggressive enough that we don't see additional deterioration. These measures. This is a word chart that was just talking about some of those temporary factors that I mentioned that weighed on growth over the first half of the year. The point is we're expecting those to reverse over the second half of the year. Now, the other area of concern in the U.S. is what appears to be a faltering of employment growth. This is monthly numbers. That last observation, you can sort of see a little bit of a blip up. That was August payroll employment. Minimal gain in jobs growth. That has raised concerns that maybe labor market conditions are starting to falter. Now, I don't want to special factor everything to death, but there was a special factor, a strike at Verizon, that weighed on that number. It will reverse in September. Our hope is employment will bounce back. I could live with a gain of 75,000, but I'd sure like to see an increase of about 100,000 to sort of ease concerns about a faltering in the job market in the U.S. Why that raises concern is that a lot of the growth to date in the U.S. has been coming from temporary factors such as fiscal stimulus and inventory building that I'm trying to illustrate on this graph. The yellow line is actually GDP growth. The dashed line separates actual from forecast. The forecast GDP growth, or our numbers, fairly close to consensus, a little bit above, but consensus is still continued growth. The concern had been, once we move into the forecast period, support from inventory building and fiscal stimulus in place right now start to fall off. And actually, fiscal stimulus becomes a bit of a drag as levels of expenditure aren't maintained. So relying on the private sector to provide all of the growth in the economy. You get a faltering of employment growth in the U.S., that's not going to happen. You need to sustain job gains to create income, to keep household spending, to provide confidence for firms to continue to invest. Now, the dark blue line there is the Obama Jobs Plan. That was designed to help bridge that gap, so the burden isn't so great for the private sector to be generating all the growth. Now, there's doubt about whether that full package is going to get through. But if you get half, there's a payroll tax cut component, you get about half of that through, it will still help to bridge the gap. The burden is not going to be so great in terms of the private sector generating all the growth in the U.S. But it is still very important for job gains to recover in the U.S. to help generate additional growth that's going to be needed through the end of next year. Now, we get the September payroll employment number out a week today, and markets are going to be watching very closely. If you get any faltering employment growth, flat again, the market will start putting a very high probability of another recession. They're watching the job numbers very closely. I don't think that's going to happen. I think you're going to get a bounce back in growth. There's a stimulus in the system that will keep job growth continuing. Some of the weakness in August is temporary. But that number a week today is going to be a clear market mover depending on what it shows in terms of labor markets in the U.S. Our expectation is job growth continues. We get a reversal of some of the other temporary factors that weighed on growth over the first half of this year. Get a bit more fiscal stimulus, and with that, growth does recover over the second half, and the growth continuing through the end of next year. Bottom line, we're talking about growth this year in the U.S. of 1.7%, next year at 2.5%. Now, that is down from the 3% growth that we saw in 2010. So, an indication this isn't particularly strong growth, and we are seeing a bit of slowing, but it is an improvement from the decline of 2.6% that we saw in 2009, reflecting the impact of the recession. Now, this graph as well is sort of meant to indicate just how hard the U.S. was hit this current downturn. I apologize, the key for those lines didn't show up on this graph, but the solid dark line is showing what's happening in the current cycle. I'm normalizing GDP for pre-recession peaks over the previous 4 cycles. Dark blue line is what we're going through right now. The other 3 lines that are above it are what happened the past 3 business cycles. The main point is this was a fairly severe downturn in the U.S. As I mentioned, the worst since the 1930s, and certainly a greater downturn than what we saw the previous 3 business cycles. The recovery's been kind of so-so, and it's more telling that you've had a very severe drop, and we haven't seen a sharper bounce back. Often you get a bit of a base effect, things get so low, once you come out of it you get an initial pretty good bounce, just things are so weak to start off. It's not happening this time. We're getting kind of a so-so recovery from a very severe economic downturn. What people are suggesting, what analysts are suggesting is going on, that this downturn was fairly unique and that it didn't result from actions by central banks. Often in the other cycles, there are inflation problems in the system, central banks tighten, they raise interest rates, address the inflation problem. Once that problem's addressed, they start to ease, they reverse policy, and then growth bounces back. What's happened this cycle was there was problems in the financial system related to subprime mortgages. It was a faulty asset. Markets became concerned about who was holding it. There was poor documentation in terms of the extent of holdings. Markets shut down because they didn't know who was holding what and to what extent. Financial system shut down. Now, measures were taken to try to address that, reverse those pressures, some success. But it's been very unique sort of economic downturn, and policymakers, central banks have been finding it difficult to sort of fully offset the pressures. Had some success, things are recovering, but not to the extent that we've seen in previous rebounds. And a lot of discussion going on that when you have financial market problems, rather than policy actions slowing down an economy, it takes longer for that economy to recover. And that is sort of very much what we're seeing in the U.S. And again, this slow rebound is creating the vulnerabilities. If you get any kind of negative shock at a time when the economy is not all that strong, it could well force it back into sort of another downturn. The risk, that's not our forecast, but that very much is the risk that we're confronting at the moment. Now, I show this graph just to sort of give some indication in terms of the housing market, which was particularly hard hit through the downturn, how we're expecting some bounce back, but not to very robust levels. I mean, the end of next year, we're talking about housing starts in the U.S. over 700,000. Pre-recession peaks were over 2 million. It's kind of an equilibrium demographic sort of calculation would suggest underlying trend in housing starts of maybe 1.5 million. So at 700, you're half of that. You know, this market is struggling. It's burdened by very high debt levels that were incurred prior to the last downturn, and it'll have lingering effects, limiting just how quickly things bounce back, even with policy being highly stimulative. An implication on labor markets is it keeps that unemployment rate high. We get some progress, but it's slow improvement. End of next year, we're still talking about a U.S. unemployment rate, 8.6%. It creates problems for the economy. It also creates political problems for Obama. It's very difficult for an incumbent president to get reelected with unemployment rates being as high as this. Now, a benefit, if you want to call it that, of high unemployment, slow growth, is it will keep inflation low. So this is despite very stimulative monetary policy on the part of the Fed, commodity prices remaining high. The weakness in labor markets, in our view, will counter it. So core inflation in the U.S., the ex-food and energy measure, will likely stay below 2% through the forecast period. A high unemployment rate, low inflation, sluggish growth. It's an environment where the Fed can keep low at its current range of 0 to 0.25%, not only through the end of next year, but even into 2013. Probably in the middle of that year before we start seeing any kind of significant move up in interest rates in the U.S. They are keeping conditions super stimulative to try to generate the growth, try to get a bit more traction in terms of this recovery. So that's the U.S. context. So not great, but at least growth is continuing. With respect to Canada, the tagline that we're going with for this economy, strong demand for natural resources, a benefit for Canada, though growth still largely dependent on sustained U.S. recovery. The pattern of growth in the U.S. will largely determine the pattern that we see here in Canada. It'll be tempered a bit by commodity prices remaining high. This is an income boost to the Canadian economy. It will also support capital expenditure. But the main pattern, I think, is going to be determined in the U.S. U.S. slips back into recession, it will pull Canada down with it. In fact, we're projecting sustained, though modest, growth in Canada will go a long way to establish a similar sort of pattern here in Canada. Now, what we've been seeing recently in Canada is pulling out of recession in the middle of 2009. Since then, we've had 7 quarters of growth. In the second quarter, we actually did record a bit of decline, minimal, but down 0.4%. Now, initially, there's some speculation or some comment about maybe we'd see another decline in the third quarter. The view, or I think the dominant view, is that the weakness in Q2 reflected some of the temporary factors that affected the U.S. economy, but as well some wildfires in northern Alberta resulted in shutdowns of a number of oil sands production. That production has started to come back, and with that, it should result in growth recovering in the third quarter. Now, we got some July GDP numbers out this morning. They were up 0.3%. I personally would have liked to see up 0.5%, but I'll take 0.3. With that, it's providing strong evidence that the decline in the second quarter is a bit of an aberration that did represent the underlying trend. With that 0.3 gain in July, right now we're monitoring growth at about 2.5% for the third quarter. So we'll bounce back to levels that we're looking at, growth levels or growth rates that we're looking at prior to the second quarter. And really, prior to Q2, the Canadian economy, has been growing a little bit stronger than in the U.S. And what's the factor there? It's the commodity price story. Rising demand coming from a number of emerging economies, the Chinas, the Indias, the Brazil. This is viewed as a real thing. This isn't sort of a fanciful, a trendy sort of notion that people are trotting out that they'll forget about 6 months from now. This is viewed as a bit more fundamental. This increased demand is expected to raise commodity prices to historically high levels. Now, they're still going to be buffeted by various supply factors, particularly in terms of areas like agriculture and grain. But in the main, the feeling is when we look back 20 years from now, start doing 5-year averages, prices for a number of commodities will be higher in the current period relative to what we've been seeing the last couple of decades. And we're clearly starting to see pressures, upward pressure, a number of key commodities, oil, base metals, grain prices all moving up. Forestry's not benefiting as much. There's been a lot of increased supply coming from some of those emerging economies. The weak U.S. economy, particularly housing, is doing a lot of contributing to some of the weakness in some of the wood products area. But there are clear evidence in some other markets of clear upward trend. And we expect that to continue. So for something like oil, though it's under pressure right now, we are expecting about an average of about $100 through next year. Also, commodities such as potash, important for Saskatchewan, New Brunswick as well. That is returning to sort of an upward trajectory. Generally, we think averaging $4.50, $5.50 over the medium term is likely for something like potash. Supportive of the Canadian economy, very supportive for the Saskatchewan economy. And the support is not only the income boost, high prices mean high export revenues. That's an income boost to the Canadian economy. We're a net exporter of a lot of these natural resources. The other channel with which it supports the economy is through investment. And certainly, recent announcements here in the province are indicating the impact as such, with a number of announcements with respect to potash facilities being added to boost production here. And through the forecast, we are expecting business investment to be a key driver in growth in the Canadian economy. We got a nice bounce coming out of the recession, a bit of a base effect. Pace is slowing down a bit, but this is solid growth. This is above average growth in terms of business investment, reflecting the strength in commodity prices along with the low interest rates. This is going to be a key driver in terms of growth in the country through next year. Now, consumer spending is one area we're a little bit less confident. A lot of attention has been drawn to this fact of the high debt-to-income ratio in Canada. Through the last recession, you didn't see this measure move down at all. It remained high. It's raised concerns that as interest rates move up, as at some point they're going to have to do, is that going to make debt servicing too onerous for households, and they'll have to significantly cut back on spending. Our view in the forecast is that these high debt levels will limit spending by consumers, but it won't prevent it from happening. So we've got very modest growth in consumer spending, below average growth in the economy. So it's adding a bit to growth, but it's not significant. The high debt levels just limit how much of a contribution consumer spending can make. And then the other thing in terms of why we're not expecting consumer spending to tank is I think Canada's quite cognizant of these high debt levels, and they're not going to push through interest rate increases if it's going to jeopardize spending on this front. They see no value in declining economic activity. They want households to continue to spend. So they're going to put in interest rate increases as a pace that doesn't jeopardize consumers continuing to spend. So it's going to be sort of the case of them testing the waters with increases, making sure the economy can handle it. If it can, it will move interest rates then higher. If they get any indication of consumer spending faltering, they will stop tightening. They may even reverse sort of interest rate increases. So that's the other factor why we still think consumer spending will add to growth, though we admit the contribution's not going to be as significant as what we're expecting from business investment. So strength in business investment, the rebound in the U.S., the reversal of some of the temporary factors, results in sort of a growth in the Canadian economy rebounding, fairly similar to the pattern that we're showing for the U.S. In terms of annual growth rates this year, we're talking about 2.4%. Next year, we're talking about 2.5%. Is down for 2010. We had growth of 3.2%, but clearly an improvement from 2009, where you saw a decline of 2.8%. Now, if we look at this business cycle, and this is sort of mirroring that chart I showed for the U.S., this is indicating this cycle, the downturn really wasn't as severe as what we saw in the 1980s. So it's not the case in Canada that this recession was the worst since the 1930s. A fairly severe downturn, but we did see a worse weakening in 1980s. And we began a pretty good bounce from recoveries in past periods, even with the recession not being as deep. And I think the factor there, where you're seeing slightly better profile growth, is this commodity price story. The income support that it's providing, the boost of business investment, is limiting the damage of the U.S. downturn. It didn't allow us to escape that recession, but it tempered sort of the hit to the Canadian economy. As well, in labor markets, we're seeing a bit better improvement in the unemployment, a bit more of a downward trend here in Canada compared to the U.S. numbers. And the next year, we're talking about an unemployment rate of 7.2, so a bit more of an improvement relative to what we're expecting in the U.S. It is still the case, so we're going to be above pre-recession lows. And on the inflation front, our view is that we'll keep inflation in Canada fairly moderate. On a core basis, we're expecting inflation in Canada to remain below 2% through next year. Now, the low inflation, still some slack in labor markets, will not prevent the Bank of Canada from tightening. It hasn't prevented from doing earlier tightening, but it will keep the pace of tightening fairly moderate. The bank's on a bit of a pause right now. I think they want reassurance that the recovery in the U.S. is going to continue. I think by June of next year, that evidence should be sufficiently strong that they will return to a tightening mode, but the pace is going to be gradual. We're only talking about a 100 basis point increase over the second half of next year, with the overnight finishing 2012 at 2% relative to the current 1% right now, and up from the trough through the recession of 0.25 percentage point. So it is up, rates are moving higher, but as you can see from that graph, that level of interest rates is still very low. You have the Bank of Canada continuing to provide stimulus into the system to assure that the recovery is sustained. Going out on the yield curve, we've got long bond yields drifting up a bit.